So today I get to talk with Gary from Garden View LLC. He's a real estate investor and he had a money problem. And that money problem was he was afraid to open his property tax bills. Just like so many real estate investors are, they don't want to pay their property taxes, but we all have to. So Gary found a better way to pay his property taxes. And in doing just one thing different, Gary was able to be the bank, pay his property taxes on time, and make money twice, and also pick up a tax write-off. Join me for this behind-the-scenes look on how Gary was able to be the bank and pay his taxes on time. We'll see you in a bit. Correction, Gary didn't make money 2 times. Gary made money 3 times. Want to make sure I got that clear. Hey folks, I am here with my friend Gary. Gary is a very experienced real estate investor. He's got a large rental portfolio, and we were talking after he saw one of our money multiplier videos about how he could use this in his real estate business, and he came up with some very unique ideas. Gary, when you first heard the money multiplier presentation, what was going through your head?
Well, originally I had bought a policy to do the debt reduction, which worked to a T. It totally helped me out, got me on the right course, and then I ended up having a flip that I was going to net like maybe about 35 grand on. So I'm like, what a better way to use it than to start another policy. So I did, and at that time I had a lot of property taxes due. So I'm like, I think I'm going to pay my property taxes with this.
Property taxes. Yeah. Oh, that dreaded day that all of us that own real estate all know what that feels like. You start getting one, then another one comes in, then you get 15 of them that show up, and you open them and you about fall out of your chair because it's a lot of money. So do you escrow right now? Do you take money from your rents and put it into a checking or savings account?
No, I didn't even open my property bills. As a matter of fact, I just let them all accumulate because I was too scared to open them. So once I got that flip done, I knew I had a lot of cash coming in. So then I started opening them. And so
right from a professional, if you don't want to, look at your tax bills, just don't open them. That's words of the wise. I love it. All right. So, with this, the biggest thing I like is that you're thinking, you're almost using the entire system. You're first when you got rid of all the debts. Mm-hmm. Okay. And when the debts were done, then you did a flip. Now you're looking at, those pesky property tax bills and using this for that.
So I'm using this policy to pay my property taxes every year. And my property taxes are about $32,000 a year. I pay myself back every month, almost like an escrow account. Works great. I actually make money on my money when I pay myself back.
So I think this is a pretty interesting story to tell because you got almost a whole life cycle in how you've used these.
Right.
So what made taxes come to you? Where did you think that would be a good use of this?
Well, it was a bill that I knew I had to pay. So I knew that was coming, and I knew it's going to come again. So it seems like a perfect scenario for that money. So if I can recoup that money and pay myself back and make money in the meantime, I thought it was a perfect way to use it.
Sort of just makes sense. Why, a lot of people that do taxes, a lot of people don't have to do what we do as investors. They just have it escrowed. It comes right out of their mortgage payment, but we actually have to self-escrow.
Right.
So if we're not doing that, well, then we can just avoid the tax bills and not open them. Or we can open them and fall out of our chair and have heart attacks. Or we can actually then start putting money away on a regular basis, to get prepared for those tax bills at the end. But when you're doing that, each one of those options involves giving up control of your money. Right. You're always putting your money somewhere else and just leaving it sit. If it's at a bank, the bank is the only one winning because the bank's earning, 400 to 1,300%. Not much more than you are, but a little bit more. They're making all the money, or you could, not pay the tax bills, let them get behind and just slowly make payments on them. What are the penalties on property taxes? I know the answer. I want to hear it from you.
I don't know. I didn't look.
Too much.
It was way too much. It was a lot.
So if you don't pay your property taxes on time, the county or wherever you're submitting the taxes to, they hit you with big penalties.
Sure.
I don't know what their interest rate is, but it's actually, 8, 10, 12%?
Yeah, it could be a little bit more than that with some of the penalties because it's penalties plus interest on top of it.
So the bank option's not a great option because the bank wins.
Right.
Paying your taxes late and letting the town or the county win is not a good option.
Right.
So what other options do we have? Oh, I'm sorry, just avoiding them. That's probably not a good option.
That's true.
So you started saying, all right, well, I've been using this banking system to pay all my other things. Why not use it for this?
Right.
So let's take a look at what that looks like. So we're going to call this Gary's World. You remember Wayne's World?
I sure do.
Yeah, this is Gary's World. So we got 9 properties, and it's tax time. So if you look at it, all we were doing before is you were taking a wheelbarrow full of money, wheeling it down to the tax office, and that's your tax man taking your money away. Kind of looks like him too. I'll tell you, he's a grumpy son of a pup. And then everybody in the tax office, they're all hiding from you because they don't want to talk to you. They don't want to help you. Oh, that guy's raising his hand, so maybe he'll help you. And then this is what it feels like every time when you actually open them. So I just had some fun with this, but 9 rentals is $32,400 in property taxes.
I have a hard time sleeping when I get tax bills in the mail.
It's a heavy load.
Yeah.
It's a really heavy load. So with this system, I think, we can really do something interesting here. So what we're going to do here is literally just change one thing.
Okay.
All we're going to do is change where your current money's coming from. So, what we're going to do is we're going to take $35,000 per year. And you can put that money in your plan any which way you want. Now, if we were going to commit, because remember over here, Taxman every year's coming after $32,400. So you're already giving that money away. This isn't new money. This is money that you would have already given to the taxman anyway. Mm-hmm. So all we're going to do is we're just going to change where the money goes first. That's it. We're going to put it in here first, then take it out and pay. But we'll talk about that in a second. So we got $35,000, but we're going to change what bank it goes into. We're going to put it in the bank of Gary. And you know all about this, but What do you think of my little piggy?
It's nice.
Yeah,
it's really nice.
That's Gary's piggy, okay? Because it's Gary's world, so it's Gary's piggy. And then what we're going to do is we're going to immediately, once we deposit that money, as soon as your taxes are due, we're going to take a loan out, okay, from your policy. Now, a lot of people will get confused by this loan. They'll think, wait a second, so I owe money to taxes. I'm going to deposit my money, and then I got to take a loan. That freaks people out because they think of a loan as something that has to be paid back. Right. But this loan does not have to be paid back because Gary's bank also comes with Gary's death benefit. So Gary's death benefit, and we'll write this in just one second, on this particular plan that we're depositing $35,000, Gary's death benefit is $680,000. So we'll just write $680,000 right there. So if we've got a death benefit of $680,000 on Gary's bank, and we take a loan, really what's happening, and you know this, but they don't, the insurance company is actually just giving you a loan against your death benefit. Mm-hmm. They're taking money out of their general account, loaning it to you at a rate of 5%. So we're just going to write this. So the interest rate on this loan is 5% here. So the insurance company is going to charge you 5%, but your bank here, this money here in the piggy, is paying you a guaranteed 4% plus dividends. And as of 2021 with this plan, your dividend's 2%. So all intents and purposes, your piggy pays 6%. Okay, so we got a 6% piggy here. We're going to take a loan at 5%. So Gary, you got a plan on how you wanted to use this specially designed whole life for your business. And your plan involved you loaning money to your company, Garden View, right?
Right.
So your company's Garden View. Because you could take money from your bank and just give it to your company, but you decided to do this different. So explain kind of what you decided to do here.
So I created a note and I lent money to Garden View, and Garden View is going to pay me back monthly payments for the note.
One thing Gary did is he took money from his bank and he loaned it to his company, but in the middle he did a note. Literally like an IOU. It's just a promissory note, which you saw a picture of it, and all it was is Gary saying, I, Gary, agree to lend X amount of dollars to my entity, and my entity is going to pay me back at 8%. And it's a 1-year term. That's all he did. Why would you do that? A lot of people would skip that step, but if you ever were to get audited, the auditor is going to look for that note. They want something in writing signed by your company, which is you signing it as the member, to show that that money flowed. So again, it all comes back to treat your money the same way you treat the bank's money. Does the bank ever just give you money and say, hey, you don't need to sign anything, you're good, here it is? Absolutely not. You sign a note at every single bank and every financial institution. So this is your bank. Make sure you follow the same rules for your money. So basically what Gary did, just like it shows here, is he took a loan from his policy for the amount of the taxes. So he puts in $35,000, like you see here. He puts in $35,000 into the bank of Gary, because this is Gary's world, don't forget. And then what he does is immediately takes out a loan for $32,400. So puts in 35, takes out 32,400, which is what he owes in taxes. But he doesn't just take that money and just give it to the tax man. He went an extra step because he wants to make money not just once, but twice. And it's very easy to do here when you understand how these plans work and how you can make uninterrupted compound interest. So Gary loans the money to his company, Garden View. So Garden View now has $32,400, but Gary's going to charge Garden View interest of 8%. So all this is, not to get too technical, and we're going to put up a actual example of Gary's note from his banking policy to his company, and he charges his company 8%. So he's going to charge 8% interest to Garden View, and Garden View is just going to make monthly payments back to him. And that's going to be done for a period of a year. Why a year? Because taxes are due every single year. You don't pay taxes once and then all of a sudden, the town or the county says, oh, you don't owe us anymore. No, the next year we get that pile of bills that we can ignore, that we can pay late, or that we can escrow money in a bank account and the bank wins on. So those are our options. So then what Gary does is he takes from his account the 32,400, okay, that he did a loan to his company, and he pays the tax man. So now all of his taxes are paid on time, right? Feels good, right? Instead of not opening them.
It does.
All right, so now the tax department's out of the way. They're paid. They are super happy. So we just made our tax man, let's see, put a little hat on him. Tax man is now happy, but now what Gary's going to do is Gary's going to then proceed to make monthly payments back to his banking policy. So what he's going to do is he's going to recapture and recycle the money that he would have normally given to somebody else, and he's going to take that money back at a rate of 8%. Why 8%? I don't know. You just chose 8% for, yeah, so it makes sense. 8% interest, okay, and then we're going to lose 5%, and this is what the insurance company keeps. So you're making a 3% spread to Gary. Not bad. I like that. All right, so Gary's making 3%, but there's something that we didn't talk about here yet, is this 8% that Gary's charging his company 8%. And because he's charging his company 8%, it's the same thing if Gary went to his local bank and his bank charged him 8%. When he paid that interest to his regular bank, he could write off that interest. He, in other words, could write off all of this 8% interest that he's paying to the bank. But Gary's the bank now. Remember, I said it's Gary's world and it's Gary's bank. So just because Gary took his own money and lent it to his company doesn't mean he can't write that interest off. It's the same thing. So this 8% interest that Gary is charging his LLC, it's a tax write-off to his LLC. So now, not only is he making money on his policy, okay, he's making 4% plus the dividend, then he's making 8% interest from the loan that he did, the note, but he's losing 5%. Because the insurance company didn't loan Gary the money for free. He's losing 5%. And in that loss, he's netting a 3% gain, true 3% gain that he's making. So he's made money twice. But then the third thing he gets is a tax write-off to his LLC. That's not too bad.
Right.
And now your LLC, you have a CPA, correct?
Correct.
And did you bounce this off of them?
I didn't bounce him off of him, but I knew it was going to work.
Yeah, and I've done this with my CPA, and I've asked him, can we do this? He said, absolutely. There's only one thing that my CPA said that I'll pass on to you. My CPA said, whatever you do, don't charge yourself an excessive interest rate. In other words, don't charge yourself a crazy interest rate that you could, if you can go to the bank and get money at 8%, charge yourself 8%. If you can go to the bank and get money at 10%, well, charge yourself 10%. You are the bank, so treat your money the same as you would treat the bank's money. That's all we're saying. Mm-hmm. Okay, so now we've got a tax write-off for this 8%. All right, so now what Gary's going to do is Gary's then going to take the money from his company, which he's collecting in rents, and he's then going to just pay that money back to his segregated bank account. Now, do you want to tell everybody what a segregated bank account is?
Yeah, it's just a separate bank account that I opened up right in my bank. So I just named it property taxes, and every month I just deposit the money right into that extra account that I have at the bank.
And then do you set up a bill pay, a transfer, or do you actually write checks?
No, I do a bill pay.
Bill pay.
Yeah, I do bill pay.
Why, with today's modern technology, why do extra work when you can literally just go in and in a minute create a bill pay and then a check or a transfer automatically happens? So Gary didn't have to really think about this. He's just going to send monthly payments. And they're going to go from his company into his segregated account in his bank account. Then from your bank account, what are you going to do from there?
From my bank account, I'm going to pay back my policy.
Okay. And you're going to set that up automatic too, right?
Right.
All right. So we're going to set up an auto loan repay. And you know what's cool about this is if you really think of math, uninterrupted compound interest, your money keeps going up. So you're always earning more and more. And we'll talk about Gary's numbers in a second. But the loan that Gary took from his bank that the insurance company is charging 5% simple interest on, every month he's paying that down. He's paying that down at a rate he's not able to put all 8%. He can only pay it down at a rate of 5%, what the insurance company is charging him, because you can't put more in than you took out.
Right.
So the extra money is just going to sit in his segregated bank account. So over this year and next year and the year after, he's going to have excess money left over in this segregated bank account that you can open a new policy with. You can buy another property.
Right.
So this is a great concept, and this is a one-year cycle. So every year you're just going to do the same thing year over year, right?
Right.
But the part people don't understand, they already got the 3% that you're making here. They understand you're making interest over here, but we haven't showed them the numbers. Mm-hmm. And I think they understand that you can write off the interest that Gary's charging his company. So that's a direct write-off. Mm-hmm. But let's look at Gary's numbers. I think this is impressive, Gary. So the first year you put in $35,000. And you're able to take out $32,699,
right,
of which we only took $32,400, okay, to pay taxes. But the second year, you're going to put in another $35,000. So year two, Gary's going to deposit another $35,000 into his bank. Okay, then he has the ability year two to take out $35,043. Now this is pretty cool because I know it's not a lot and you don't get excited about this, but he puts in 35 and he now can take out more than what he deposited. And the best part about this stage of a policy, we call it the efficiency zone, mm-hmm, is at this stage in the policy, every year that goes on past this point, whatever money he puts in, he gets more out than he puts in. And we'll show you those. But the other thing too Gary did is Gary didn't just take a loan and not pay the loan back. Gary made his company, Garden View, pay his policy back. So therefore, he paid himself back the $32,400. So in year two, he doesn't only have $35,043 to use. Gary has $67,742 because he did the same thing he would have done with someone else's bank with his bank. Now, there's one problem here, though. In year two, are your taxes going to go up to $67,000?
No, as a matter of fact, they're going to be lower than the $32,400 because I got so many fees and penalties on that.
Oh, that includes all the fees and penalties.
Oh, yeah.
So not only was Gary practicing the don't open the envelopes, when Gary did open the envelopes, he realized the penalties, which he hasn't yet realized, the penalties that he's going to get charged. So next year, his taxes just went down because he's paying them on time. Just messing with you.
Oh, well, we are in New York State, so they probably will go up.
That is true, yes. New York State, we're going to probably have to have increased property taxes to pay for everything that the state can't pay for. We'll leave it right there. So every single year that goes by, Gary's going to do this. And if you all just look at this, it's just a circle. Each year, his only work is he has to sign a new note and charge himself 8% or 6% or whatever he wants. Gary's in control. You see, the cool thing about being your own bank is you control all the terms of your loans. You know, one of the things that I find a lot of people just can't wrap their head around is, if it's my money, why would I loan my money to my own business? Your business is not you. It's a separate component. That's why we set up companies. It's why we set up entities. So when you loan money from your bank to your company, it makes logical sense to me, but to a lot of people, they're just like, that doesn't make any sense. Why would I charge my company interest? It seems like it's, going to cost me more money. You keep all the money. That's the part you're missing. You are the bank, which means every payment your company makes to you is your money. So that is the part that I think people need to start thinking about is when you become the bank, you're in control. All the money flows back to the source, which is your bank. That is a highly missed thing. When you take a loan out from your bank, you can charge whatever you want within reason to your LLC. If Gary were to take a loan out from his bank and then lend that money to me on a real estate deal, Gary could charge me whatever he wants. He is in control. But you know what else Gary's in control of? How much money he pays back every month. Let's say you sell one of your properties, you know, and I don't know, you get a windfall of $20,000. So you're making these normal monthly payments back to your bank. Right. But then you sell one of those 9 properties. You have a windfall. You have 2 choices. Number one, you could pay the loan back that you were doing monthly payments on all at once, but that would hurt you because then you wouldn't get the write-off. Or you could just take that money, set up another banking policy. I mean, you got so many options here.
Well, that was an issue with me because my mentality is pay the loan down fast. So if I'm coming across 20 grand, I want to pay that loan off. But it's a mind shift, you know, and I can't pay it off because I'm making too much money at it.
That's true. Because if you pay this loan off, you just got rid of your 3% spread that you're making here.
Right, I don't want to do that. So I've got to find something else to do with that 20,000 or whatever I end up getting.
Well, that sounds like a personal problem Gary's got. And, you know, it's okay that Gary's got a personal problem because it's Gary's world. So let's keep going back into the numbers because I think this gets pretty fun. Let's just fast forward 5 years. It'll feel like it's going to, you know, be an eternity for 5 years to go by. But in 5 years, Gary, you deposit $35,000 into your plan here. Okay, and that $35,000 that year gives you the ability to take out $39,000. So that is pretty exciting because $35,000 immediately turning into $39,000. You didn't have to work any harder for that.
No.
Gary didn't work any harder for that money. He didn't take on any more risk. He lost no control of the money. All he did is changed where his money went first. And because of that, 5 years into the future, that $35,000 he was putting in now equals $39,000 that year. But Gary that year, you see, because he's doing this, he's recycling and recapturing all of the money and paying himself back every year, because that's just how it works. He's being the bank. He has $180,972 in his account. That's way more than what he's going to need for taxes. And just to kind of look at the numbers behind that, we did our mapping team did a map for him. Also a cash flow, which is what we're looking at here. And also we did a cash on cash return. So if you look at the numbers here, the cash on cash return in year 5 is 11.58% on Gary's money. So he puts in $35,000. He has access to $39,000. That's an 11.58% cash on cash return.
That's crazy.
But wait, there's more. In 10 years, you do the same thing, but you can't put 35 in. We only put 34,600 in. That 34,600 you put in gives you the ability to take out 45,212. That's a 30% cash on cash.
Right.
This is that vending machine that just keeps on giving, folks. 15 years, he puts in only 14,000. So in all these plans, when we usually get to year 10, we're not going to be able to put any more money in after year 10 than we can't put the same amount in. So Gary's only able to put 14,000 in year 11 on. That's about 60% reduction. But you know what's cool is we don't really talk about this much, Gary. But if for some reason you had a hard year, COVID-13 hits, right? And you don't have the $35,000 you can deposit that year.
Right.
You have the ability to reduce your premium deposits down to $14,000.
Right.
I always tell people, when we build these plans, we're going to give you a lot of flexibility in them. It's not your obligation, it's your option to deposit the amount that Gary's depositing. It's his option to deposit $35,000, not his obligation. His obligation would be about $14,120. So at any time, Gary can go from 35 to as low as 14,120. That's his minimum. But in year 11, it's just automatically going to drop. So if we go to year 15, back to the numbers, you put 14,000 in, and you have the ability to take out $34,000. Now, I might not be that good at math, but you put $14,000 in, and you have the ability to take an extra $20,000.
That looks like
$84.
I've got like a $20,000 vacation coming up.
I'd say. you put 14 in, you have 34,000 you can take out. Of that 34,000, 14 is your deposit, but $20,084 is true
That's
gain.
amazing. Yeah.
Wow.
In 15 years too.
Our buddy Albert Einstein calls this the eighth wonder of the world. The theory of this mathematical equation simply states this: those that understand compound interest shall earn it. Those that do not will pay it. Which side do you want to be on? I then called it the eighth wonder of the world. And he earned this interest inside of this specially designed and engineered whole life policy called privatized banking. To me, that should be the eighth wonder of the world. Gary is now understanding it, and because of that, he's making 143% cash on cash return in year 15. In year 20, forget about it.
Yeah.
Is that how they'd say it?
Yeah.
Forget about it.
I don't know if I'll be alive that long.
20 years. So 20th year, he puts in $14,000, has the ability to take out $44,000, and that's a 215% cash on cash return. Yeah. You know, Gary, I hear this all the time when people see this, and it won't be any different for your problem here, your money problem. People are going to look at these numbers and say, that looks too good to be true. Yeah. Or they're going to look at this and say, well, why would I take my money and loan it to my company? Yeah. How would you answer that if someone said that to you?
Why wouldn't you?
That's the best answer.
Geez.
Why wouldn't I? Because you would have borrowed the money from somebody else, or you would have put the money in a bank account, taken the money out of the bank account, and it's all the same thing. We're not talking about new monies here. Right. This is the same money that Gary was saving already. All he did is changed one thing, and that one thing is whose bank he deposited the money in. So the $35,000 you're putting into your bank, where did that money come from?
That was from a flip that I got.
Okay. So you made $35,000 from a flip, you put it in here. You know, one cool thing about this was the circle, right? Gary's world. We just showed his money going around the world. And all it's going to do is just like a spaceship or just like anything in space, it's orbiting the Earth. That's his money. Your money always should be in motion. This concept, this system allowed Gary to move his money over and over again and make money twice during the process. And he also picked up a tax write-off to his company, which he needed. Money in motion, baby, around the world, around Gary's world. You know, with what Gary's plan is built on, it's built on the same thing that all real estate investors build their business on: cash flow. Money comes in and money goes out, but in the middle, we make a profit. And that profit can come from rent roll, just like you are. Mm-hmm. Okay, it can come from selling the properties. He does lease with options.
Lease with options to buy.
Yep, so his tenants technically buy the property. So when that happens, he gets a liquidity event. So there's all sorts of ways to make money in real estate. All he's doing is just changing where the money from his real estate business goes. And in doing that, it enables Gary to keep control of his money at all times. It allows Gary to get tax write-offs he normally wouldn't have with his LLC. And also, it allows Gary to finally pay his taxes on time so that he's the one winning, not the tax man and not the bank. I love this.
I do too. The only thing that kind of pisses me off a little bit.
Gary's pissed in Gary's world.
Is I've been a real estate investor maybe, I don't know, since maybe 15 years or so. This is the first year I've done this. If I would have started this back then and started paying my property taxes, I'd be at that year 15 right now. And I'd be set, you know? Now, I should have done this way long ago.
So I always tell people, I always say, you know, when is the best time to plant a tree?
Yeah, it's either 15 years ago, like I should have.
And when's the second best time to plant a tree?
Well, probably today.
Yeah, right now. Oh, yeah. So you can either worry about the tree you should have planted 15 or 20 years ago, or you can start worrying about the tree you should start planting right now, because that tree right now, we just showed you what that will look like in 15 years. And that's Gary's story in Gary's world. What does your world look like? So let's create your world, and you can benefit from the same thing that so many others have and take advantage of uninterrupted compound interest, the eighth wonder of the world from Mr. Albert Einstein, who, just so you know, was a genius. And you can then start playing the same game that we're playing by being our own bank. Thanks for joining us.
So I wish I would have started these policies years ago. I just started them this year for this particular one. Boy, I'd bet you I'd have a lot more properties and a lot less unopened mail.
So Gary was already successful, and I would say he was already ahead of the game, but by doing this one change, by adding this one step to his business, this completely changes everything he's doing. By now making money 3 different times, getting tax write-offs, and paying his taxes on time, I think Gary's even further ahead than he was. And you know what? That's because it's Gary's world. Gary's in control, and all Gary did is move his money, vroom vroom, around Gary's world.